I'm going to try and tell you why I think silver is the world's cheapest asset. First, I'm going to jump into some economics and some macro and tell you what I think are the things that we need to be to keep our eye on. Inflation is a big one. I think it's about to come back and surprise a lot of people. Not everyone, as I'll show you, but a lot of people are really not expecting this. And as inflation persists, and I think we're going to also either hit a recession or at least some form of economic slowdown. Certainly, the tariffs are helping that along the way a lot. And I think stagflation is going to start to become one of the more searched terms on Google Trends. We have to look at and watch what's happening with stocks and bonds. I think the S&P peaked back in February. We're still about 8% below that. It's been a 40-year bull market. I think it's time for a rest. Bonds are really in the toilet as well, really struggling. And I think rates are going to continue to go higher. Bonds are going to keep selling off. I think both are in a secular bear market. And the third big asset is the dollar. And I think we're in a new trend, a longer-term trend for a bear market in the US dollar as well. Now, just a few months ago, if I remember correctly, Fed Chair Jerome Powell was saying something along the terms of, I see neither the stag nor the inflation. Well, back in just last month, he was speaking to the Economic Club of Chicago and said the following: the level of the tariff increases announced so far is significantly larger than anticipated. The same is likely to be true of the economic effects, which will include higher inflation and slower growth. So I think he's starting to come around to understanding and seeing the stag and the inflation. This is one of my favorite slides right now because this explains how we're getting to stagflation. Inflation is up, growth is down. The chart on the left shows the 3% monthly change in the core personal consumption expenditure, which is the Fed's favored inflation measure. It's actually turned up very sharply recently. It's at about 3.5, 3.6. That's a long way from the Fed's 2% target. So that's why I say inflation is up and heading higher. And then the chart on the right shows the GDP growth in the US, and we had the first quarterly downturn since Q1 of 2022. That's 3 years later. There are some outliers and things that might explain that. Obviously, the tariffs, again, could have some big influence, a lot of stocking inventory and so on. But I'm not so sure. And if we get another really, really soft or weak read, then a recession is looking that much more likely once again. And here's interesting in terms of how I think that the general consumer is seeing things. University of Michigan does some great research on this in terms of inflation expectations. And you see that spike all the way over on the right. The average one-year inflation expectation is at 6.5%. And that's US consumers. That's the highest it's been since 1981 when we went through the 70s, where we saw 15 and 20% annual inflation. So the dollar. This is a chart that shows the last 50 years of the dollar, the US dollar index. It peaked in around 1985. It peaked again in about 2002. And I think it peaked again in 2022. And it goes through these roughly 7-year cycles of run-ups and then rundowns. And we were recently, just until a couple of days ago, back below 100 in the dollar index. I think it's going to eventually head lower. We're probably in a relief rally right now, but probably heading somewhere to that 80 to 95 range. And Trump wants a weaker dollar. We had that the first time he was in office. We're having it again now. And like Chen said this morning, tariffs are worse for the US than anyone. So that's certainly going to help get us a weaker dollar. This is an interesting chart that shows the dollar superimposed on 10-year yields. And what has happened, if you look at where we are way over on the right, 10-year yields have shot up, the dollar fell. That's not what normally happens. The dollar usually follows yields. If yields go up, people want to have the yields help to support the dollar, and this is basically a sign of market stresses. So again, things are not normal. You do not typically have stocks down, bonds down, and the dollar down, and that's what we've had over the last couple of months. Really quite interesting to see these kinds of things shift like this. And some of the effects of a weaker dollar. Well, capital starts to flee U.S. treasuries and U.S. stocks. Naturally, people don't want to own assets where that underlying currency is weak and weakening. A weak dollar means deficits will persist and likely worsen. That's going to be self-feeding for inflation. And under a weak dollar kind of outlook, you have hard assets that tend to do well. So precious metals and commodities tend to outperform. Again, our best analog is the 1970s, and that's how things played out. What's going to help support inflation? Well, we're now in a sort of a new paradigm where we have a lot of spending on defense. The world's becoming polarized. Trump is talking about a $1 trillion defense program for next year. They call it the Golden Dome. It's similar to what Reagan talked about in the 80s, the Star Wars idea of protecting the U.S. from the skies and from space with satellites and so on, being able to shoot down missiles and that kind of thing if they should come into the airspace above the U.S. UK just announced a $2 billion package to support for loans to companies that would buy U.S. defense products. Germany and Europe is looking at a $1 trillion defense infrastructure and climate budget, and that's from Germany that's been so totally against, overspending has been typically very, very conservative, and now is willing to do away with all of that and spend like crazy and spend especially on defense. And then the last one is when we move into recession, we should expect to see a lot more quantitative easing, a lot more money printing, and again, all of this supporting more inflation. And this is an interesting chart. It just gives us a quick overview year to date where we are. Gold's up about 20%, 25%. Silver's up about 14%. All the Wall Street traditional assets are down so far this year. 10-year yield is down. S&P, NASDAQ, dollar. People are starting to see this in their investment, in their brokerage statements, and they're going to start to look gradually for things that are working. And of course, that's the later money. The smart money does the research and sees these things earlier and starts to rotate. And we're starting to hear that. I've heard twice in the last couple of weeks, large fund managers have said that they've got family offices and other fund managers come in and say, we feel we don't own enough gold and silver. It's not that they're ready to buy yet, but their minds are starting to open up to it. And they're starting to try to understand this space better. And they certainly realize that they need to have more exposure. So that's really a very, very interesting change of pace. So why is silver the cheapest asset? Back in 2011, when silver was $50, even at that point, silver was just above 0.06, just slightly higher than half of 0.1%. Try to wrap your mind around what that means. That means that globally, almost no one owns any kind of realistic, impactful amounts of silver. This is more the supply-demand fundamental side of things. These are numbers that come from the World Silver Survey. They just released their 2025 report last month. And so we're into the fifth year. Assuming this plays out, it's very likely we're going to be this year in the fifth year of a structural deficit. If you include investment into silver ETFs, that last bar would be a lot lower. In fact, Chen showed a slightly different chart that includes investment flows into ETFs. And So I've got, my opinion about where these numbers should be, and I'll talk about that soon. But the point is that even the Silver Survey, the Silver Institute sees deficits for years to come and actually expects to see record deficits in silver in the next few years. Now, a couple of quarters ago, I started talking about the influence of AI and data centers and the amount of power and of electricity that this sector needs. And we've heard a bit about some of the bigger names, especially turning to nuclear. And that makes sense. It's baseload power, it's very steady, it's very cheap, it's essentially carbon-free, but the access to nuclear power, especially if you want to turn it on quickly, is almost completely unavailable. So I was arguing that we're going to see these same tech giants go to turn to solar. And I got a fair bit of pushback because solar is not considered base load power. Well, this chart on the left shows, I think this is over the past year, carbon-free energy contracts by US tech giants. That bar all the way over on the right, that's solar. That's 34 gigawatts of solar versus nuclear at 7.5. That's almost 5 times more commitments towards solar as a source of power for the data centers and for AI than for nuclear. And I mean, some of the reasons are obvious. It's faster to permit. It's obviously carbon-free. You can be relatively self-reliant. It's just a quick build. Obviously, there's a larger footprint, but this chart on the right is also very interesting, and that shows the amount of time it takes to deploy solar versus other sources. So solar is 1.4 years, nuclear is 15.3 years. So it takes you 1/10 the time to deploy solar versus nuclear, and that's why I think we're going to see a lot more solar continue to be sourced for power for tech giants for all of these data and AI centers. Now, let's dig into some of the numbers from the World Silver Survey a little bit. Here we've got the top line is mine supply. So mine supply peaked in 2016 at 900 million ounces. 2024, 819. They think it's going to be up slightly. 2025, we'll see about that. It's not so obvious sometimes, and a lot of things are very unpredictable when it comes to bringing mines on. Total supply was 1 billion ounces. That includes recycling. That's 2016. We're barely above that. So demand has grown by 15 to 20% over the last 10 years, at least, probably more, and yet supply has been flat. And that's why we have those deficits. Now, some more specific numbers. Solar is really what I call the 800-pound gorilla in the silver space. It was 80 million ounces back in 2016. It was more than double that, 192 million ounces in 2023. The survey says that in 2024, it was 197 million ounces. I think that's a lowball number as well, and they think that it's going to actually go slightly down for this year. I also don't agree with that. Here's one of the reasons, one of them at least. Bank of Montreal says 2023's number should have been 232 million ounces. 2024 should have been 246, and that this year is going to be 261. That's 33% above what the Silver Institute says. Here's another bone I have to pick. The Silver Institute excludes investment into silver ETFs. So when you exclude them, you're still looking at a deficit, about 12, 15% or so. If you include the investment in silver ETFs, the deficit that they forecast this year, because of 70 million ounces they think will go into silver ETFs, is going to be the 3rd largest silver deficit we've seen probably ever. Now, the bone I have to pick is they essentially say that silver flowing into silver ETFs should not be included in the overall demand because it's not consumed. It flows into the silver ETFs. It remains available to flow back if people sell it back or if they sell their ETFs. My question is then, why do they include coin and bar demand? That's technically, silver that's not consumed and could also easily flow back if supply is needed and people are willing to sell it. So they include this, but they don't include this. So that's why, as I say, I have my differences, but I at least follow this for a matter of trends in the silver space, and it's certainly very bullish. It continues to be very bullish. Another reason silver is looking very, very cheap. The gold-silver ratios, if you look back, this is the last 50 years of gold-silver ratio. It reached over 100 only 3 times. This is the 3rd time right now. We're at about 102, 103 to 1. The first time was in about 1991. It didn't stay there very long. It dropped pretty quickly, bottomed out at 50. So that's, if gold were to stay where it was, silver would double versus gold in that kind of scenario. It went actually to about 125 intraday or so I believe it was March of 2020 when COVID hit and everyone panicked. And then only recently, again, back right around 100. And if you look, just about every time it went to 80, just about every time it went to 80, it dropped pretty quickly, went down easily to 50. At 100 now, I think it's pretty realistic. Expected to come down, I think, pretty conservatively, again, down to about 70. And if we have that kind of scenario at $3,200 gold and 70 to 1 to silver, we're looking at $45 silver. That's a 40% gain from where we are right now in silver. Silver is a tiny industry compared to gold. Now, if you look at the amount of silver available every year versus gold, it's about 1/10 in terms of value, and yet the silver mining industry is less than 4% of the gold mining industry. Just absolutely tiny in comparison. And when the money starts to flow into the industry, that's when the stock prices can go absolutely crazy. And we've started to see some of that happen already. So this chart goes back to late February when things bottomed in February of 2024. And so the dark red line is the SIL ETF, which is a basket of mostly silver miners. That's up about almost 70%, whereas silver is up about 40%. So it started to outperform quite nicely. Now these numbers on the left, again, I kind of take them with a grain of salt. I think they should be considerably higher, but for a matter of trends, it makes sense. This is, again, from the Silver Institute. So they're saying that last year, cash costs were actually down. All-in sustaining costs were actually down. And they're saying that it's mostly because about 75% of silver comes as a byproduct of mining other metals, mostly gold, copper, lead, and zinc. And as these other metals prices go up and you use them to credit against your silver production and it brings your cost of producing the silver down, it actually, those higher prices in the other metals help. And most of those other metals have mostly gone up. Gold's been a big one, obviously. So gold byproduct credits have been really high and have helped the silver price, the silver production costs to come down. And this is kind of where I'm going to mostly end the talk on silver. You know, hopefully you see that the case has been made for silver being very cheap. And if you look in just on the near term and on a seasonal basis, silver tends to actually move sideways to slightly downwards over the next couple of months, maybe 6 weeks or so. And this is a tremendous window of opportunity. If it plays out on an average like it has over the past, say, 50 years or so, we could get a bottom in the silver price right around the end of the month of June. Now's a fantastic time if you feel you don't have enough exposure to silver and silver stocks to start doing some research and build some knowledge in some of these companies. There's some tremendous value to be had. And hopefully I can help with that. I write the only silver-focused investment newsletter that's available out there. I cover everything from physical silver and ETFs, including the mining ETFs, the large producers and royalty companies, all the way down to the junior explorers. It's a weekly letter. I have some commentary as well in there and weekly updates on news from all of the companies in the portfolio. So you can follow me and look that up at Silver Stock Investor. I'm active on Twitter. I'm on LinkedIn, and just 3-4 months ago launched a new service called Silver Advisor. It's a way for people to get introduced to the silver space and silver mining equities. This is a free letter, so if you want to sign up and go and get to learn more about some of these silver companies, you can sign up for free. Just go to thegoldadvisor.com/registration and sign up there. That's it. Thank you very much.